Alternatives may be these private companies, right? So private versus public is what a lot of people will define as alternative. And alternatives being it can be oil and gas, it can be real estate. There's so many different sectors that can kind of qualify to be in that alternative investments category. But each one serves a different purpose, right? The main goal of alternatives is to get out of your exposure and to diversify. But most people that come to alternatives are looking outside of their readily available public markets.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is Jay Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Matt Spagnolo. Matt is a former residential and commercial agent turned capital raiser, now in capital markets with Colony Hills Capital as fund co-manager. And in just a minute, we're going to speak with Matt Spagnolo about capital markets and alternative investments. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Matt Spagnolo. Welcome to CREPN Radio.
Thanks for having me. Glad to be here. Super excited to chat.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a second and tell the listeners a little bit about your background.
Yeah, absolutely. So my initial background and education is in business and economics. And then I ended up getting into equities, options, more so on the stock market side of things, straight out of school, and then wanted to pair that with some sort of real estate investing or just pair it with real estate. And I ended up getting into the sales side just to learn the business, build a network, learn a lot about the industry. And then we started to develop within our sales team, the residential and commercial side, a little bit of an investment team where we were flipping homes, and I was part of the team that was looking at smaller multis. So we wanted to start scaling, right? And moving from the single family homes to maybe a duplex, a quadplex, 40 unit buildings. And I was doing a lot of the underwriting, trying to find deals, talking to brokers, and then ended up getting connected with my now CEO, Glenn Hansen, at a conference in New Orleans. And we just kind of hit it off. He was looking to scale Colony Hills Capital, and we are still scaling, but wanted additional help on the capital market side. And that was relatively new to me, but gave it a shot and ended up raising several $1,000,000 for one of the deals for him. And then he decided to bring me on board with the team here at Colony. And now I work specifically with retail, high net worth, family office investors who come in either on a direct deal basis or they come into our fund. So that's a little bit about my background. Happy to elaborate or share a little bit more as well.
No, appreciate you sharing the background, and it sounds like you're uniquely equipped to raise the capital and probably explain to investors, what you're doing and how the options or what the options are, and how real estate can be a good fit for their portfolio. I'm curious, just as far as a starting point, when you talk with investors. What are they seeking, and why do they go with real estate as opposed to other things like in the stock market?
Of course. So anytime I'm starting out a new conversation or a new relationship with any investor, right, from a newly accredited investor to a smaller institution or family office, the conversation still starts the same. It's, hey, what are you looking to do? What are you looking to accomplish, right? Each investor has different goals. They're in different phases of their investment journey. I like to try to find out as much information about the investor first, similar to a fiduciary or a financial advisor. I want to get to know you, the investor. And some people are coming from, hey, I just sold a large business, to others are, hey, I'm 100% allocated to stocks and equities, and I feel that the market's a little bit overheated. So some people are looking for the depreciation aspect that you can get with real estate. So there's a wide net that comes with what type of investors, what they're looking for. I think a lot of people are looking for diversification outside of the real estate or the stock market if they feel it's a little bit overheated. A lot are looking for that depreciation to offset some of their passive or K1 income coming in. And others are former real estate agents or brokers. They love the industry, but hey, you know what? I'm tired of being the landlord and running everything myself. I'm going to stick to more of these passive investments, and be a little bit more hands off. So that's kind of the wide range that I typically see. But each investor is unique.
Got it. And as far as the opportunity in to invest, if people aren't, investing in, and I guess we should clarify for the listeners. I'm sure most have a good understanding, but real estate is in through syndication that is considered a alternative investment, correct?
Yes, that's correct.
Okay, and characterize that as opposed to what the traditional options are.
Yeah, an alternative investment is what a lot of people say outside of the stock market or sometimes these publicly traded equities, right? So everything that's on the stock market that you can pull up your brokerage account, those are all approved products by the SEC and things of that nature. Alternatives may be these private companies, right? So private versus public is what a lot of people will define as alternative. And alternatives being it can be oil and gas, it can be real estate. There's so many different sectors that can kind of qualify to be in that alternative investments category. But each one serves a different purpose, right? The main goal of alternatives is to get out of your exposure and to diversify. But most people that come to alternatives are looking outside of their readily available public markets.
Gotcha. And as far as the opportunities for people to invest in alternatives, can you explain a little bit about the requirements in order to be qualified to invest in alternative investments?
Absolutely. So most offerings, private placements, alternative investments, similar to what we do at Colony, require investors to be what's called an accredited investor. And that, at least right now, has to do with financial uh, circumstances or qualifications, as well as potentially education qualifications as well. So the financial side is to be an accredited investor. Some of you may be accredited investors and maybe not know it, is making over $200,000 a year, or if you're married jointly, over $300,000 a year for the previous 2 years, or having a net worth of over $1 million, excluding your principal residence. So those are the two most popular qualifications. There's a long list of small qualifications, and you can research those. But if you hold certain licenses, you can also be qualified. So a lot of financial advisors that hold a Series 7 or a Series 66 or 82 license also are accredited investors as well. But achieving that accredited investor status allows you to get access to a lot of these private placements and different options that allow you to invest. I believe the SEC is potentially working on a test that you can take to become an accredited investor. They're just trying to, we were talking a little bit before the show about risk. They're trying to lower the risk for somebody who maybe doesn't want to put their entire net worth or has a small amount of net worth, putting that all into maybe a riskier investment. So that's a longer-winded definition to to what you were asking, but happy to elaborate more on that as well.
No, I appreciate that. And I think one of the things that I don't know if everybody understands in kind of the way you were described, and I like the simplicity of the public versus the private, is that a lot of these private placements aren't available through, I mean, you can't go to your stockbroker and say, hey, I want to get into a syndication. Um, you've got to, you know, find an investment or somebody like yourself in order to take advantage of something like that. Um, and so that's kind of why I think, if people don't know where to look or who to look for or what they're looking for, they end up in something more of a traditional, publicly traded option there. So,
I think a lot of people don't even know, like you said, that that's even out there, that that's an option to invest in some of these companies or these other offerings that aren't public, right? They're not always advertised. Some of these, depending on what the private placement is, they can't advertise. They're not allowed to based off of the certain offering. So that's maybe why a lot of individuals aren't used to it. And what I pride myself in, and we do at Colony, is honestly an education, right? When we come in and you're investing for the first time, either with us or you go to another private placement or alternative investment, it can be everybody's got to have their first time doing it. So I like to take an education role as well to that, making sure that, hey, here's all of the risks. Here's why we are different than a publicly traded offering. Here's the things and requirements that we have that are different. So I encourage everyone to be educated on that. And if you meet those criteria, there's so many options that are great investment vehicles. And there's great sponsors who are competitors to ours that also do a great job. So there are so many different unique options, and it allows you to get outside of the publicly traded markets.
it's great. As far as the risk and reward, the public versus the private, can you broadly speak to, what the differences might be?
Yeah, to your point, it's kind of a broad question. I would say that we like to look at everything as risk reward, right? The more risk you take on, the higher IRR, the higher projected return we like to see. And then, hey, we want to go with maybe a little bit more conservative opportunity with less risk, or we're eliminating certain risk factors. Okay, we are probably not going to be projecting as high of a return as we would with a riskier investment. So I don't think that there's a ton of difference, to be honest with you. There's different types of risk, and a lot of the big ones, right? Market risk, geopolitical risk, a lot of those interest rate risk, they affect both public and private markets. And then outside of that, within each category, there's different risk factors for real estate than there may not be for another industry. So each industry or asset type or asset class has its own risks that come with it. But for us, we judge how risky an investment is and our willingness to take that on with what the potential reward looks like on the back end. So risk adjusted returns, if people are familiar with the Sharpe ratio, I encourage you to check that out as well, or learn a little bit more about that, which stocks, if you're into public equities, have the highest Sharpe ratio. But that's usually how we're evaluating opportunities.
Got it. And we've talked a fair amount about the accredited investors.
Mhm.
Where else do you guys find capital when you're raising for a deal?
Absolutely. So when we bring in a deal, right? So we have our fund, which is just an accumulation of all of the individual deals that we do. At Colony, we allow investors to invest in the fund level, which automatically diversifies your money, or you can put all of your investment into one specific property if it's near you or you really like the opportunity. And then on each deal, we have retail high net worth investors, family offices that come in, but then we also have smaller institutions. So they can be private equity funds, they can be pension funds, they can be these larger institutions that are handling billions and billions of dollars. They'll usually bring a larger check into each of our deals. So we bring one institution in, and then we syndicate or bring a bunch of high net worth investors together. And then with the three of those forces combined, we buy a 50 to $150 million property.
Got it. And the size, I appreciate you sharing the size of deals you guys are working on. Is there any particular region that you guys focus on, or is it more opportunity driven?
I think it's a good combination of both. I think that our regions are shifting, right? when you talk about risk, right? Risks change. Everything that's going on in the Southeast right now with natural disasters, hurricanes, tornadoes, etc. Now snow in Florida, and insurance in Texas and in Florida has skyrocketed the last few years. So Colony historically had been in the Southeast, right? Texas, Florida, Georgia. And now we're making a pivot back into the Northeast when that got neglected after COVID. A lot of people left, say, Manhattan or downtown New York City, but not everybody went to Florida. A lot of people went to Connecticut or Massachusetts and Boston, and we find that these regions in the Northeast are have significant supply constraint. And what I mean by that is the biggest risk that we see right now in multifamily are these thousands and thousands of units that are coming on over the next 3 to 5 years in the Southeast. So in Georgia and in Florida and in Texas. And by the time that that gets absorbed, and all of the rent or the population growth that's happening in these states, that combined with the new units coming on, rents may not continue to increase for the next 3 to 5 years versus some of these affluent areas in the Northeast that we are investing in. There's not a ton of land to build. There's not a projection of new units coming on. So I'd say, to answer your question about where we are, historically, we love the Southeast, but we're picking affluent select areas depending on the opportunity in the Northeast where we see there's a supply constraint, where occupancies are 97, 98 plus percent in the entire market. So it's a constant shift, but I think that's one thing that's allowed Colony to be successful for over 15 years is we see the opportunity before it happens. Let's be one of the first movers and pivot before we're late to the game.
Yeah. No, it's interesting how the market does change. I mean, COVID, Southeast was like a magnet for everybody to move here because it was, open and, the weather and people could work remotely and all that. And, it's funny though, is just how the market has changed. I mean, I'm assuming you've seen values, right size in the Northeast, where they're creating opportunities. Is that fair? I mean, beyond the demand you talked about for housing?
Yeah, I mean, rents haven't really gone down in the markets that we're buying in the Northeast. I mean, the occupancies are 95 to 98 plus percent, like I mentioned. The issue that in the Northeast too, right? Yeah, the other side of our competitors, which are the apartment complexes, is residential housing, right? That's our other competitor. And when the average house price is 500 to 600,000 in some of these affluent areas, you're looking at paying $3,000 to $4,000 a month for a mortgage with how high interest rates have been versus paying 2,000 or 2,500 at some of our apartment complexes. It's not even a close comparison, right? They're not even a value alternative to be able to go buy a house. That's the other dynamic that I think in the Southeast, that when interest rates hopefully come down a little bit, making housing, residential housing, a lot more affordable. There's a ton of homes on the market in Florida and in Texas right now. And if interest rates get to a level at 5% for res or retail, that you'll see a lot of renters go purchase that home or that first home. So that's the other dynamic. Again, going back to the common theme here is risk, right? We have to factor in the residential market as well. And from the background in residential, I usually bring some sort of thoughts or comments to our team on what that looks like.
Got it. And as far as the strategy you guys employ for investing, you mentioned the size, the number of units. Is there a value add component, or is there um, any kind of a common theme, or is it more about acquiring a well operating property that you see opportunity to increase rents, or can
Great
you speak to
question.
that?
Great question. Yeah, our strategy, we already hit on the dollar amount. The size is usually over 200 units, and then we usually are about 30 to 45 minutes outside of a more urban city, right? Whether it's Boston or Atlanta, we want to be more in the suburbs and these what we call garden style apartments, which are these beautiful communities, right? They're not the high rise 15-story buildings, excuse me, where there's dog park, gym, volleyball courts, basketball court. We want to create that community feel to all of our complexes. Um, we always have some sort of value add aspect, right? And that can vary based on the opportunity. A lot of opportunities that we see, in the most common one is obviously unit renovation. So taking a property that's 20 to 30 years old, has strong bones, but hey, you know what, those interiors are a little outdated. We're going to come in and over the first 3 years renovate anywhere from 50 to 90% of those units. And we're going to do that and over time increase rents. Again, it's not all going to happen right away in year one. And then sometimes there's balance sheet value add. So a team that has mismanaged the opportunity where the units are in good condition, but hey, the property management team in place wasn't doing a great job of keeping the property occupied. They have uncontrollable expenses or controllable expenses that are way above the norm. So each deal will have some sort of unique story with mismanagement, either on the CapEx side or on the balance sheet. And our job as the experienced sponsor is to come in, identify if there is that opportunity, and what we can do in a short amount of time and get that property stabilized and then exit to an institution or a group that's looking for more of a stabilized asset with not a ton of work to do. But our typical hold period really is only 3 to 4 years. Our longest hold in 15 years was 5 years, and the shortest was 2 years and 3 months. So once we hit that 3 year window, ideally, we've got a couple of years and some flexibility there to exit for our investors.
Oh, you kind of hit all the, I was going to ask you about the whole time and all that. That's great. Do you find that your investors, once they, see the way that the deal works and the performance, do you have any kind of a sense of percentage of those that want to invest in the next deal?
Yeah, we see a ton. I don't know the exact number off the top of my head. I believe it's over 50% come back for the next opportunity, right? Or they allocate more capital to the fund. Again, we have that flexibility of different ways to invest. Obviously, it depends on our deal flow, right? If we don't have a direct deal for investors to invest in, they might have to hold off or wait until that opportunity comes up. But on deals that have gone full cycle, we've achieved an average IRR of 36% for our investors. So we're definitely more growth focused. There is a cash flow component, but we focus more on that appreciation side. You also get your share of depreciation to offset some of that passive income coming in. So that's why we love real estate, is that combination of appreciation, depreciation, and cash flow, are the big three-headed monster there.
Yeah, that's kind of what makes it all work. Um, as far as the current interest rate market, how is that, or or I guess, how is it affecting your current strategy?
Yeah, I think that again, because we have to constantly be moving. I talked about moving markets earlier. We have to adjust internally with our underwriting as well for interest rates, right? If we're going to be in this new norm now where we're not going back down to 3% interest rates or 2.5, and we're going to play ball in this 4 to 6 range, we have to change our underwriting from day one to what our underwriting and pro forma looks like 5 years out or even 6 years out. So for us, we're going to be a little bit more conservative on some of those exit assumptions for exit cap rates and interest rates. And then we will always do a sensitivity matrix as well. So we will run the numbers on, hey, if we are 100 basis points above our projected exit cap, and then 100 basis points below, and see, okay, if we're 100 basis points, if we're underestimating by 100 basis points, are we still okay with those results? And that's something that our underwriting and acquisition team definitely does. So we have to factor that in. But when you talk about buy criteria on the front side, we want to buy with what we call positive leverage, where the interest rate that we're getting today for flat numbers, if it's 5%, we want to be buying a deal that has a cap rate above that. So at least 5.25 to we'd like to see even over 5.5. So, for example, the deal we are about to buy in Connecticut, we're assuming the debt at 4.8%, and day one going in cap rate is almost 6. So we have over 100 basis points of positive leverage day one, and this is probably going to be one of the higher cash flowing deals in our portfolio because of that factor. So that's pretty much a non-negotiable for us right now, is going in with positive leverage. There are a lot of sponsors and operators, unfortunately, right now that are being a little bit too aggressive with the cap rates that they're buying and going in on day one at. And they think that they can just force that appreciation and force rents up. And if they're not able to execute that strategy over the first few years right away, they're going to be in trouble. So any operators or sponsors that you go to, make sure you ask that question about what's the spread there between the interest rate they're assuming or buying and what the cap rate is going in on day one.
Yeah. Are you finding opportunities, I mean, to be able to assume an interest or an existing loan? I'm curious, what kind of runway is left on that loan?
Yeah, it was a relatively newer loan. So we have 10 years of term left and four
Wow.
years of interest only. So that's another big factor. One of the biggest risks we were talking about in multifamily, right, is getting a loan that's too short on the term, right? Is having something that's due in 36 months or in 3 or 4 years and you not being done with your timeline. So we've got a ton of flexibility on this one specifically, but anywhere between 5 to 10 years is usually how long the term of our loans are. We won't go shorter than that.
Got it. And as far as the lending, what kind of percentage loan to value are you seeing in the market currently?
I'd still say it's pretty low. So anywhere between 55 to 60, 65%. We use agency financing, so they're being pretty conservative on that side. So we're pretty much in the 60% range. Some of the private debt will go a little bit higher than that, but I know a lot of underwriters and debt vehicles are not going as high as they used to, that's for sure.
Yeah. No, it's definitely an education if you go look at the last few years and see, the interest rates, the leverage rates, and just how it's all changed relatively quickly.
Yeah. One
You
other
know,
point that we're seeing in the capital market side, we talked about the debt, but what is equity looking like? There's a ton of pref equity out there in the market right now. And for somebody that's maybe not familiar with that term. It's just preferred equity, which if you're talking about the capital stack and who gets paid out first, senior debt is paid out first, then pref equity gets paid first, and then the common equity is last. And a lot of people want to play in that in between space where, hey, we're willing to have a capped return on the upside, but we want to make sure that if anything goes south, we're the ones that get paid out before the common equity. So we're seeing a ton of that. So what we'll do, right, if that's what the market's telling us, we will do even lower on the debt side, right? 50 to 55%, and then make sure that that pref equity position, instead of using it for 90% of the equity, will only come in for 40 to 30 to 60%, right? So we still want that total loan to value or loan to cost, if you include the pref piece, to be that 75 to 80%. So the combination of the debt as well as the pref equity, we want maximum that to be 75 to 80%. And then the common equity or common investors to be the remaining 20 to 25% of the entire purchase.
question for you. This just occurred to me. I know a lot of times interest only loans are kind of a vehicle that help the numbers work. When you're raising, the pref equity and that, is that is it treated as an interest only type return, or as far as an expense in the capital stack, or is it um, you know, uh, can you speak to that at all, or am I
Yeah, so
making
there's
sense?
there's different types of pref, and
Okay.
it depends on the institution, right? Some institutions can be heavier on cash flow where they want a percentage of that cash flow during ownership or on a quarterly basis, and then there's other pref groups that still want to be in that in-between spot in the capital stack, but they're willing to accrue that return. And they say, hey, we want to be paid first before the common equity, but we're willing to sacrifice the cash flow and to have a higher number on the back end. So it really just depends. We have a very unique circumstance with a deal in Connecticut where we only owe the LP or the pref equity group 1% on their $10 million. So we only owe them $100,000 of cash flow during ownership. And then they're actually capped at a 7% return. So once they hit a 7% return on the sale, we wipe out their equity and all remaining proceeds go to the common equity investors. So each deal is going to be a little bit different. That's very, very, very unique. I challenge anybody to try to find pref equity terms that are better than that. Usually we see 6% on cash flow and during ownership, and then the total be 13 or 14%, and that's the first thing that gets paid out on the back end. So each group's a little bit different, but depending on the opportunity, if it is higher on cash flow, then we're willing to pay a little bit more to that pref group during ownership and less on the back end. But if it's a heavier lift or a heavier value add, we want to accrue that cash flow and then pay our common equity investors that cash flow during ownership, and then on the back end pay the pref group. So it's again kind of pulling strings and making the opportunity or the equity fit with the opportunity, if that makes sense.
Yeah, no, it hadn't really occurred to me until just now about the flexibility in raising capital as far as what you're able to offer the investors. I think most of the deals I've talked with syndicators about has been more different class of shares,
Mhm.
but somewhere along either a monthly or quarterly distributions, perhaps a refi cash out, but the rate of return and then the return of capital at the end, you get some sort of a blended rate, or not a blended rate, but I mean there's a net rate at the end, kind of thing. But it, like I said, it just occurred to me like you could structure how that return, you know, is paid back. Like you were saying that, if somebody doesn't need the cash flow up front, but just more of it on the back, or however, uh, I guess it pays to be creative and find out what the market's willing to take. So
Especially when the market's tight and not a ton of deals are going through, right? Volume's been significantly down over the past 12 to 18 months. We have to get creative. You have to get creative to continue to do deals, to be able to place investor capital. And I think the combination of our team finding off market and mismanaged deals is great. But then once our acquisition team brings an opportunity to myself and my partner Julian on the capital market side, how can we get creative? How can we structure the deal with different types of equity that are able to give our investors the highest possible return? Right. And we have to sometimes brainstorm and we'll have conversations on, hey, if we do this instead of that, or we bring this group in for this percent, and we'll just get super creative versus having just a fixed structure. If we had just a fixed structure, we wouldn't be able to do deals, especially right now. So finding what works on each deal because it is so different, right? If we're assuming the debt or we're taking on new debt, there's so many different moving pieces. How much capital we have currently on hand. So many factors go into it, but my partner's background as a debt and equity broker is super, super helpful. So he's got this vast network of pref equity groups, common equity, more of the larger institutional equity that he can go to and put an opportunity, say, hey, we're looking for this, this, or this. Is anybody interested? And that really allows us to put the pieces to the puzzle together for each opportunity.
yeah, no, I just the thinking outside the box, and the cash flow thing is anybody that's operating a large property, especially if you're doing renovations and depending on how you're capitalized, the cash flow can be the deal killer. If you're not able to, um, or if your expenses are too high, and if your debt's not structured properly, I mean that can be problematic. So I appreciate you sharing that on how you guys are able to be flexible and work through that.
Yeah, of course. I'm seeing a lot more investors are wanting cash flow. It really obviously depends on the individual, but the deal we have right now that's available for about another month is very, very high on cash flow. So usually our value add deals on average are anywhere between 6 to 8% average cash flow over the 5 years. The deal we have is almost 10% cash flow with 7% right out of the gate. So we're seeing that investor interest is coming in pretty swiftly because it's a higher cash flowing deal, which is pretty unique for us. But I think the feedback from investors is telling us that, hey, we want some cash flow and we pay quarterly distributions, but for it to be 7% right out of the gate. And if we even shorten that time frame instead of 5 years to 4, the cash flow jumps over 10% to closer to 11 because that interest only kicks off in year 5. So um, I think investors are wanting that security with cash flow, especially with maybe some uncertainty, so to speak, in the market.
Sure. What kind of minimum investments do you entertain?
It'll depend on the deal. We like to get $100,000 from each investor, but sometimes we'll make that sacrifice depending on the opportunity. If investors are like, hey Matt, I really want to get into this deal, we pretty much draw the line at 50,000. So usually the minimum investment ends up being 50,000, and then if you want to invest in our fund, the minimum's even lower. So it's 35 for the fund.
Got it. Got it. Well, hey, Matt, if we could, I'd like to shift gears here for a second.
Yeah, good.
As I mentioned to you earlier, by day I'm an insurance broker. And as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your investors, the market, interest rates, political environment, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Matt Spagnolo, what is the biggest risk?
Yeah, I would say the biggest risk in multifamily has to be interest rates, right? Interest rates are something in I like to say the biggest risks, at least with what we do at Colony, is something that we can't control, right? We believe in our team and the systems and processes that we've put in place. What we can control, we can live with that, right? But what's tough is the items that we can't control, like you said, insurance and um, interest rates. So we've made a shift to help on the insurance side of things, right? The properties we had invested in Texas and in Florida and the Southeast that maybe are seeing a higher jump in insurance, we are going to these properties in the Northeast, like I mentioned. We're making that shift geographically. The insurance number itself might be high in the Northeast, but the only thing that we care about as an operator is what is the year over year change. As long as that's consistent and relatively predictable, that's what's important to us, right? Because we can underwrite to that. But if you're in some of these states where it's very unpredictable, you could see a huge increase one year and then it flatlines for a year or two, and then there's another massive increase. That volatility is something that worries us. So we are going to markets where the year over year change, regardless of how expensive it is consistent and is relatively predictable and has been for 15 to 20 years. So that's something that we're doing to try to eliminate that insurance risk. However, interest rates, one, nobody knows where they're going, and two, if they did, they probably wouldn't be working. They'd be on Wall Street somewhere. But right, it's up to the Fed to kind of control the Fed funds rate, and then that will also affect some of the other rates that we see in multifamily, right? And even with Fed funds rate coming down, we've seen that the 10-year has gone even higher recently. So that's something that we can't control. What we can do is make sure that we're buying our deals right at a good cost basis. But the sale rate, our cap rates, what we're buying and what we're selling at, really just depends on what the interest rate is. I mentioned earlier we want to buy with that positive leverage. If the buyer on the back end of a deal that we are selling is using the same strategy, their purchase price is going to move, not depending on the income of the property, but on what the interest rate is, right? If they have to get a new loan. So that's such a risk, and it's a very big one. But if we think that interest rates are going to find some sort of normalcy or flat out or flat line here between that 4 to 6% range, I think that's something that we would love to see is some stability, right? Regardless of what the number is, just again the year over year change being consistent. So to answer your question, I'd have to pick interest rate risk.
Yeah. No, a little bit of stability. It's definitely easier to manage. Weird thing is that I've come to recognize, though, is that what makes the American economy work so much is the highs and lows. I mean, as far as the investor opportunity is, you have those dips and then the rise and that, and it's frustrating when you're riding something that's going the wrong direction for you. But in the overall picture, I've come to understand a little bit better. Not that it's easier to accept when you're in something that's going the wrong way. but kind
I
of
think
just,
something that's important to understand is the market has to breathe, right?
yeah, yeah,
And it's because I see it all the time. I still follow the markets and the stock market on a day-to-day basis, and you get a 5% pullback in the S&P 500, and people are freaking out that it's going to be the next 2008. But the market has to breathe, right? The market has to pull back to go higher. Think of it as a slingshot, right? If you can't not pull back a slingshot, or else it's not going to go anywhere, right? So there are these market cycles that happen, and I think why a lot of people love alternative investments is because they're often have longer time frames, right? And the ability to exit those investments is longer, right? So Colony, we give ourselves a kind of 3 to 4 year window to be able to exit a property, right? So if the market's not right in that first year, okay, we can wait it out a few more years and find a time that is good to sell. So you have to understand that the market cycles are going to happen, right? Just because there's a big pullback in the market, you have to pull back to go higher. So it's letting the market breathe. Sometimes the market needs a reset, but don't be so scared of the pullbacks. Those are the buying opportunities, right? Those are the times that you
right,
should be investing more, which sounds
right,
counterintuitive, but look at any of the wealthiest people in the world. They're the ones who invest the most when there's a discount, right? 20, 30% off in the S&P 500. Look at the historical chart, right? Zoom out is something that a buddy and I like to say is he's a financial advisor, but we like to say, hey, zoom out, right? Look at the bigger picture here. The trend is still up and to the right, and this pullback is just a blip on the radar. So, and anytime there's a market freak out, there's a lot of with social media and TV and ads and everything. Everybody loves to put fear into the market, right? Because the
yeah.
big money wants to buy those dips. So that's just a word to the wise, and I wanted to say a little piece on that.
No, appreciate the perspective. Hey, Matt, where can listeners go if they'd like to learn more or connect with you?
Yeah, absolutely. I'd say our website, colonyhillscapital.com, is a great spot to learn about our team specifically. So if you're interested in any of our direct deals, you'll be able to access them directly on there. Our fund is also there as well. You can schedule time to meet with me one-on-one. I'm also super active on LinkedIn as well. Love connecting with like-minded people in other industries as well. But find me on LinkedIn, Matt Spagnolo. Would love to chat with anybody and would love to connect.
All right. Well, hey, Matt Spagnolo, I can't say thanks enough for taking the time to talk. I've learned a lot. I look forward to doing it again.
Thanks, Darren. Appreciate you having me on.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.